on the business. So while that's also being shown there on the screen, so you will see the subsequent slides are sometimes not consistent with this sentiment. On the domestic front, 83%, if I move to the next slide, 83% of the CEOs polled indicated that they anticipate a moderation in India's growth momentum during this year because of this fallout. The next point, please. So the expectation is that it will be in the range of 7.5 to 8.5. That's like 65% of the population here, which is lower than, let's say, the CII position of about 9%. If I go to the next one. So now this is where there's a bit of a disconnect from the first answer. So top line growth, 66% says better top line growth in H1 compared to the H2 of last year. Next slide. And 64% says the bottom line growth will also be better. H1 compared to H2 last year. Next slide. And 74% says investments will also be better, in FY22, better than FY22. So overall, these, I guess, are obviously positive. If I move to the next one. Again, 64%, indicate that the prospects of employment will be better. So that's again a positive feedback. And if I go to the next slide, 50% of the CEOs are of the view that exports will also be better in H2 compared to the first half of 22-23. Or rather, first half will be better than the second half of last year. If I go to the next one. Again, inflation is a concern. It's kind of split between those who feel it's a temporary phenomenon and those who think it's here to stay. If I go to the next slide. And now we come to more RBI specific suggestions, points. Again, 52% of the CEOs feel that the RBI should allow for an orderly transition to a lower exchange rate. If I go to the next slide, 45% feel that RBI will maintain status quo on policy rates, and 37% expect an increase in the repo rates. Yep. And if I go to question 12, again, this is more about how do we deal with the impact of global oil prices. So again, the last 2 points are the ones which came out as suggestions. You could tick on more than one answer, and that's why you see the numbers are more than 100 in this case. So I'll now request you to, share your thoughts with us, and then we'll open it up for questions if you're okay. You want to speak for me? Yeah, sure.
Good afternoon. Shri Narendran, Chandrajit Banerjee, my old friend from Tamil Nadu days. You made a mention about 1991 Tamil Nadu. So he was in CII Chennai that time. Mr. Munjal, Sanjeev Bajaj, ladies and gentlemen, and members of the National Council of CII, members who are present here, and I can see some of them participating through the virtual mode, and they can be seen on the screen. Now, I'm actually delighted to be here this afternoon because perhaps this is the first public interaction I'm doing in the physical mode after the pandemic. I don't know whether it is right to say after the pandemic, but hopefully I'm right, and we will not see a recurrence of the kind of recurrences we have seen over the last 2 years. In fact, it is exactly 2 years today that we complete the first, experimental or the trial lockdown, a single day lockdown, which was observed on March 22nd, 2020. It was a Sunday. And I was just checking the calendar on the way. And I found that, today we are exactly 2 years, 21st March. And in last 2 years, The world has gone through a massive amount of transformation. And thanks to the developments which are now happening around Ukraine, I think the entire world is experiencing a great degree of transformation. COVID, followed by the geopolitical crisis, which has now come up around Ukraine. Technology has changed during this entire period. When the lockdown was introduced, I think there was a lot of apprehension how businesses, how government offices, and how various functions will go on in the economy. But thanks to technology, I think everything moved, and within a matter of weeks, the businesses got adjusted to it. COVID protocols were developed in our lives, in businesses, in any place which involved a congregation of more people. Even the marketing, the retail marketing also underwent substantial change. Business methods, business models have changed. COVID has produced a substantial impact on lives, livelihood, economies, and geopolitics. And economies and geopolitics, life and livelihood have also been impacted by the crisis now around Ukraine. Now, what I propose to do today is that I wish to speak for about 15 minutes or so, and I would like to just touch upon the RBI's approach during this entire period, and then come to the current situation and the way forward, the outlook. Of course, as far as monetary policy is concerned, or issues which are part of the monetary policy, I will not be able to speak much because I don't want to preempt the monetary policy's decision. And also between now and 8th of April, it's still a long way. I think in the remaining, today we are on 20, so in the remaining 17, 18 days, I think many things can change. And today it is very difficult for me it is not appropriate for me to say something on monetary policy and then find that the situation changing, and it would be appropriate I leave it for the MPC. So I will not touch upon those issues. So broadly, therefore, I will first touch upon the COVID response of the Reserve Bank. Now, our first effort when the lockdown was introduced, in fact, by the first week of March of 2020, if you recall, some cases of COVID in India had been reported in Kerala to begin with, and a few other states. And by about middle of March, it became evident that we will not be immune to this new virus. So in RBI, the first thing that we did around middle of March, around 17th, 18th of March, the first thing we did is that, we were very conscious that the financial markets, the money markets, and all the markets which are in the regulatory jurisdiction of RBI, they should function normally. So we immediately decided to set up a quarantine facility outside Mumbai in Kharghar in our data center. We sanitized the whole place. And about 200 of our employees, RBI officers, staff, and service providers, which ultimately went up to about 250, they were put in quarantine. And that time the testing protocol, etc., had not developed, but we did a general checkup and they were put under quarantine. And within just matter of 3 to 4 days, we were able to put up that quarantine facility. We had hired a hotel, entire hotel had been hired where all these 250 people were put. So that was mainly to ensure that the markets, that is the money markets, the GSEC markets, the forex markets, they function normally, because it's quite possible that in the main, in our office, in the central office, people may get affected. So that was the first thing we did. And then going into policy around that time, also around 22nd, 23rd, we decided to advance the Monetary Policy Committee meeting. And we also decided, around that time, we did decide that, the central office building also, we decided to close down and sanitize it. And we activated our guest house, which we have in Nepean Sea Road, not far from here, which became a kind of a parallel office only for the governor, deputy governors, and a very few senior officers. So that became a parallel office from where we functioned almost for 2 months, because we didn't want too many people to come to the office and risk themselves and cause risks to others. So, and on a need basis, other people were called or we talked to them on, on the VC mode. And the first So therefore the first emphasis was to see that the financial markets and the financial sector, they functioned normally. Infrastructure side, we had ensured that the markets, all our the markets, they run normally through the quarantine facility. So therefore we advanced the monetary policy committee meeting, and parallelly we worked out other measures. And our approach, our focus was to reduce the cost of money. So we cut interest rates by the repo rate by 75 basis points. We had to see that the financial markets, which it appeared were freezing up, there was no activity in the financial markets happening, and within matter of a week or 10 days, the financial markets appeared to be freezing up. So we decided that liquidity should not be scarce, there should be abundant liquidity. So we announced liquidity infusion measures, through this long-term repo operations, the targeted repo operations, through which we injected huge amount of liquidity. And subsequently, as we went ahead, we announced other regulatory and other kind of dispensations and reliefs. But one interesting thing which we did, learning from past experience, that almost every announcement that was made, whether accepting perhaps the rate of interest rate reduction, accepting that any liquidity infusion or any regulatory relief which had been given in terms of moratorium or in terms of restructuring of loans, everything had a sunset date. So all these reliefs, liquidity and other support system to the economy, they had a starting date, they had an end date. Because we didn't want to leave them open-ended and repeat the bitter experience and which we have gone through over the past. So that whatever liquidity goes in, it comes out on a particular date. For example, the cash reserve ratio for the banks, which is normally at 4%, it was reduced to 3% exactly for 1 year. And it ended at the end of 1 year, excepting we gave some 2 weeks extension towards the end, but it ended. The liquidity we injected, most of it had a sunset date, that we are giving it for 1 year or we are giving it for 3 years, and a lot of it has in fact come back. If I can tell the figures, we announced a total liquidity support of about 17 lakh crores, over the last 2 years or so. Out of 17 lakh crores, what the banks, the small finance banks and others, they availed was about 12 lakh crores. Out of 12 lakh crores, as I speak to you today, 5 lakh crores have already come back. And rest of it will mature at the end of the 3rd year. And some of it also will come back in the intervening period. But having done that, I would like to make it very clear with a lot of emphasis that even going forward, we will ensure that there is abundant liquidity in the market for the credit system to be active, for the credit system to function normally. And we will ensure that there is no scarcity of liquidity. There will be abundant liquidity to meet the productive requirements of the economy. So that is a clear statement which I wish to make while we are pulling out liquidity. You see, when you inject liquidity, you are entering into what various people from time to time describe as a Chakravyuh. Everybody knows how to, a lot of people know how to enter, but very few people know how to come out. So it is therefore necessary that you have sunset dates. And so far as RBI is concerned, the day we announced that we entered into that Chakravyuh, we planned for the exit route also. And we will come out smoothly. And our effort has been to ensure that the whole process takes place, both injection as well as withdrawal, in a very non-disruptive manner. And throughout this entire period, we have used communication as a tool of monetary policy. The idea was to give market confidence. The idea was to give forward guidance to the market, to market players, what comes next, because there was so much of uncertainty and apprehension. A lot of forward guidance had to be given. So therefore, from time to time, the monetary policy statements, which I make on behalf of the Reserve Bank and the monetary policy every 2 months, that became an instrument of communication. Monetary policy statements were earlier just about 10 minutes or so. Now the monetary policy statements are about half an hour or so, because we give a lot of forward guidance to the markets. And so communication became a major instrument in this. Our focus was also on the banking sector. In fact, throughout this period, we had to deal with the failure of a large systemic, not systemic, but a large scheduled commercial bank. The Yes Bank, the crisis came up. In fact, we were fortunate that we were able to take the measure in a very innovative way. We dealt with that problem, and just before the pandemic set in fact, the new board of directors of the Yes Bank had been put in place. Then during this period, we had challenges from, again, another small private sector bank, and the merger with DBS Bank that took place. Then we have so many other cases of few other cases of NBFCs and banks. So all of these cases, the RBI rose up to the occasion. In each and every case, we came out with innovative and new kind of solutions. So it was not, so our approach in the entire period has been going beyond or looking beyond the rule book. It's not as if a problem is there and a rule is there and the rule says that if this happens, do this. Now, that's not enough when you are dealing with a pandemic related uncertainty. That is not enough when we are now looking at the new crisis, which we are now confronted with because of the war in Ukraine. So therefore, RBI has gone much beyond the rule book. We have tried to be as innovative as possible. And I must compliment my colleagues in the Reserve Bank who are risking their lives through their entire 2-year period, who have been constantly, regularly coming to office and working with me. And all of us have been working as a team. So the financial sector, we had the problem of NBFC also. There were large NBFC failures, referring them under the IBC. So therefore, and also not that, we have also during this period come out with new regulations. In the banking sector, we came out with a new governance document, which is now implemented. For the NBFCs, we have come out with a new scale-based regulation. For microfinance institutions, last week, we came out with a new regulatory framework. And now for ARCs and for other, urban cooperative banks also, new regulatory guidelines are in the pipeline, and they will be announced in the next 1 or 2 months. And so as a result, and also throughout this entire period, in fact, I recall, I think 2020, when I interacted with the CII, I had mentioned it also at that time. I had referred to it, our effort to impress upon the banks to mobilize additional capital. And throughout 2020 and 2021, we have been emphasizing on this point, and I am happy to report that almost all banks, both public and private sector banks, have raised additional capital. And today, as I am speaking to you, the capital adequacy of banks is well above the regulatory requirements. It's about, at the system level, it's at 16%. The gross non-performing assets of all banks put together are at an all-time low of 6.5%. So that has been possible because of the kind of, approach which we have taken. Of course, the banks have also risen, they have risen to the occasion. They have also responded very proactively. So that, I think, and also the provision coverage ratio, that is the provision the banks make for their bad assets, that also today stands at about 69%, which is a very robust figure. Now, all this has resulted that the process of recovery is now on, and the RBI for last 2 years has remained supportive of the growth, and we have resisted all temptations and all expectations and all, if I should say, all expectations and temptations, let me leave it at that, of reversing our monetary policy and moving away from accommodative stance, moving away from support to growth into a kind of a tightening regime. So we have resisted that. And there is a reason for that. Because if you recall, in 2020, for a couple of months, in 2020, I think it happened in September and October. 2021, it happened in May and June, when the inflation crossed 7% in 2020. for 2 months. And again in last year in May and June, it exceeded 6%. There was a lot of expectation and there was a lot of sort of, a lot of analytical pressure on us through newspaper articles, magazines, articles that RBI should do this, that, but we resisted that temptation because we could clearly foresee that the inflation will moderate, and it did moderate. Because you see, the point is, if you start compressing, if you start initiating a premature demand compression through monetary policy action, then it would be counterproductive. Monetary policy addresses the demand side issues. Supply side issues, which is, in inflation, there is a demand side issue, there is a supply side issue. If there is excessive demand that leads to inflation, if there are supply chain problems or supply side problems as we have now, that is for somebody else to deal with. That is for the government to deal with. But demand side is what monetary policies world over do. Either they sort of tighten the interest rates, squeeze liquidity, and try to compress the demand. So a premature monetary policy intervention would have resulted in demand compression, and that would have been counterproductive for growth and revival. And when the economy was facing the prospect of a grim prospect of a negative growth in 2020-21, that was not the time to, sort of think of changing your stance. The RBI continues to remain supportive of growth. What we will do in the next monetary policy is something which we will discuss. Our minds are kept open. I think some media friends are available. So I would make very clear that please don't start your interpretations. Don't take anything as a signal. Don't take anything as a signal that the RBI is thinking in terms of this or the RBI is thinking in terms of this, because I am not giving any signal or any indication. So therefore, I don't want to see a headline tomorrow that RBI is thinking of this or thinking of that. Just leave that. Let the MPC meet and the MPC will decide. But having said that, I would like to say that we are conscious of our primary responsibility of maintaining price stability, of maintaining inflation, and the inflation numbers, a lot of developments are taking place. For example, the crude prices touched $130. They came down to $99. Today, they're $112. So we really don't know how it is going to pan out. New supply chains are developing. And during this entire period, so what has happened is that everybody, you said that in your opinion poll among the CEOs, everybody expects the global growth to slow down. Everybody expects inflation to rise up. So there are also challenges coming with regard to supply side issues of shipping charges, non-availability of containers, container charges, and other kind of supply bottlenecks. But I think overall what is happening is that the trend towards globalization today is being challenged. There are disruptions taking in the realm of globalization. But I am quite confident that the world will recalibrate and readjust to these challenges and come out of this problem as it has done in the past. At another level, we can expect some positive developments also out of, it's not the right word to say positive development, because there is loss, there is suffering, there is loss of life due to war, but certain trends can be sort of expected. And at another level, we can expect a faster transition to renewables and green energy because of these new sanctions and pressures on energy supply, particularly supply of crude and gas from Russia to other European countries. I would expect a faster transition to green energy and renewables happening in fact in all countries, because it creates so much of uncertainty with regard to availability of gas and crude. It is also possible, secondly, that there will be revival of investment on fossil fuels. Advanced countries which have been talking about climate change and which had not been investing at all, or maybe investing very marginally in fossil fuel, will now be forced to invest in fossil fuel and ramp up their production capacities and actual production. But at the same time, defense expenditure is likely to be high, especially is likely to be higher than in the past, especially in the European countries. And that would put pressure on their budgets, that would put pressure on their fiscal. And will it be at the cost of welfare expenditure in those countries? That is something to be seen. Now, so far as India is concerned, these are not really, major issues for us. These are major issues for the European countries, which I said. But India, we have our own transition path towards renewables and towards, climate, towards green energy. And that, of course, India is well poised to achieve them. Now, looking at the current situation and looking at India's prospects, I think overall, the Indian economy is far better placed. And I'm saying it for two reasons. Number one, the high frequency indicators. And in RBI, we monitor more than 60 high frequency indicators almost on a day-to-day basis. And that includes production of, let's say two-wheelers, passenger cars, commercial vehicles, tractors. It includes things like GST collections, e-way bills issued. It also includes air freight, railway freight, air passengers, port activity. So there are about more than 60 high frequency indicators which we monitor. And today when I was morning looking at it, the high frequency indicators, and we look them in terms of red, orange and green. Red, I did not see anywhere in the last column, which is the latest data we have. Excepting, I did not see red, but I saw orange in, for example, in tractors, in two-wheelers, in three-wheelers, and maybe one or two. But when it came to GST or e-way bills, or it came to, several other important activities, I find that they were in green. That means things are looking up. But again, these are numbers, and given the kind of uncertainty which we have, so we have to see how it pans out. But so far as India is concerned, even now the high frequency indicators of economic activity broadly look, they are in the green zone. The other thing which is very important, if you compare ourselves with the 2019 taper, 2013 taper, when we, unlike the 2013 taper tantrum, unlike 2013, today, we have in the run-up to the current crisis meaning because of the war in Ukraine, in the run-up to the current crisis, our current account deficit is very, very low. And secondly, our forex reserves are very high. Over the last 3 years, our forex reserves have gone up by almost $270 billion or so. In January 2019, it was about just little below $400 billion. Today, as we are talking here, we have foreign exchange reserves. The latest data is 622 billion US dollars. That is already a published figure. Other than that, we hold a lot of forex in our forward assets, which will mature from time to time every month. And today we are holding about 50 to 55, in fact, to be precise, 55 billion US dollars. We are holding it in the forward market, and they will all come back to us in the coming months. So 622 plus 55, our reserves are 677 billion US dollars. India is comfortably placed to deal with any effect of spillover or any challenge with regard to financing of current account deficit is concerned. So economy is better placed today. On the external sector also we are better placed, but we are living in an uncertain world. There is no reason for complacency. We have to be watchful, and we are monitoring this very closely. We are also monitoring the crude and commodity prices, the volatility. Very closely, we are watching them. Worries have been expressed in certain quarters and in several quarters about, the inflation going up in India. As I pointed out earlier, similar situations prevailed in 2020. It also prevailed in 2021. Today, again, the inflation for the last 2 months has been 6%. Whether it is the situation is similar, only time will tell. Our earlier estimate, which we had given about the inflation scenario, we were looking at inflation, CPI inflation to be 4.5% by March of 23. Now we have to watch. I will not like to comment what is our expectation on inflation and growth, because that is something which I would like to leave for the monetary policy. But having said that, I would like to very emphatically say that while we are watchful and monitoring all the trends, international, global trends, regional, domestic trends, with regard to economic activity, with regard to inflation, with regard to growth, we are watchful, but at the same time, I can say that we stand committed, and we are confident of dealing with any emerging situation and dealing with any emerging challenge. That kind of commitment and confidence is there in the Reserve Bank. As we have done in the past, we are confident that we will be able to do it in the future also. So I'll stop here. Thank you very much.
Thank you, Mr. Das, for a very positive and reassuring speech. A few points before I open it up for the Q&A. Firstly, the support of 17 lakh crore that you talked about was timely and done in the most pragmatic manner. Thank you for that. We also heartened by your assurance on sufficient liquidity. I think that's always a concern of industry, so it's good to hear that. We also see that RBI is buying the rupee and selling dollars, and that's also something which is sometimes comforting for the industry. And your assurance on forward guidance is also very important. And you talked about the Chakraview. I think India has been a good example of how it has got in and got out of the situation. So thank you very much for that. I'm going to open it up for Q&A. So we'll probably do 3 questions at a time so that you can respond and then address the others. So first from Uday. Yeah.
Good afternoon, sir. I must say that the RBI's role in the last 2 years to ensure systemic stability and protect the country has been phenomenal. And I can say as a practitioner, it has truly, in many ways, saved India and helped it navigate through the last 2 years. I'm going to go back to February 10 statement of yours, sir. And this was on the backdrop of the demise of Lata Mangeshkar. And I will quote from your statement. Quote, as the great Lata Mangeshkar, whom we lost recently, sang in her immortal song, Aaj fir jeene ki tamanna hai. Together with the spirit behind the next line of this beautiful song, she has conveyed an eternal message of optimism. Closed. For the benefit of the audience, the second line of Lata Mangeshkar's song was, Aaj fir marne ka irada hai. So the 2 lines went, Aaj fir jeene ki tamanna hai, aaj fir marne ka irada hai. Maybe it was prescient in terms of the Russia-Ukraine crisis. Very soon,